Hey friends, glad to have you back. Today, we're diving into something exciting. So awesome to see you all again. Today, we're diving into something super exciting. Get ready for a fun ride. You're asking for a fantastic and practical approach to long-term wealth building with Indian mutual funds, specifically tailored to different age groups and a consistent monthly investment of $10,000. The core principle here is asset allocation, which should generally shift from aggressive to conservative as an investor ages and approaches their financial goals. Key principles for all portfolios. Forever wealth means thinking long-term, like 10 years or more, so you can really grow your money. Want to grow your wealth? Start a monthly SIP of $10,000. Consistency is super important. And always go for direct plans with the growth option to keep those fees low. Diversification is key. Spread your investments across different market caps and styles. And don't forget to review and rebalance annually to keep your asset allocation on track. It's super important to stay aligned with your goals. Just a heads up. What happened before doesn't mean it'll happen again. Markets can totally shift. Consult a financial advisor. This is general advice. Professional can tailor it to your specific risk tolerance, financial goals, and existing investments. Got some cool portfolio mixes for different age groups to check out. Plus, I'll throw in some recommended funds as of mid-2025. Just remember to double-check the latest fund performance and news, okay? Here are the top 6 Indian mutual funds you should totally check out for 2025. These funds have really shown they can grow over time and are pretty popular for long-term success. Just remember, how you allocate them can change as you get older. FlexiCap Fund. The reasoning behind this choice is pretty solid. It has a great track record. It's a nice balanced approach, and it even includes some international stocks for that global flair. Mid-cap fund, It's the mid-cap fund really shines because it's got strong growth potential from those up-and-coming leaders. Plus, it's shown some solid performance consistency over time. That's pretty impressive, right? Small-cap fund? The idea here is that small-cap funds can really skyrocket in value over the long haul. But you got to keep in mind they can be pretty bumpy along the way. It's like a roller coaster ride, right? Large and mid-cap fund. It's all about mixing the solid stability of large caps with the exciting growth potential of mid-caps. This combo really gives you the best of both worlds. Value fund. The idea here is to spot those hidden gems, undervalued companies that just need a little love. This approach gives you a fresh way to invest, and it can really shine in all sorts of market conditions. It's all about finding opportunities where others might not see them, Aggressive hybrid fund. Hybrid funds are a great pick because they give you that sweet mix of equity exposure and a bit of debt for stability. On the flip side, infrastructure funds really dive into India's growth story. It all boils down to what you're comfortable with in terms of risk, So, think about what fits your style best. Let's dive into how to analyze your portfolio and allocate your investments based on your age, with a monthly SIP of $10,000. The core idea here is super simple. 100/120ths age equals percent in equity. It's a handy rule of thumb that helps you figure out how much of your investment should be in stocks versus bonds as you age. For example, if you're 30, you'd have about 90% in equity, which is pretty solid for growth. But if you're 50, that drops to 50%. The rest often goes into safer bets like hybrid funds or pure debt funds, especially for those older investors looking to balance risk. It's all about finding that sweet spot for your financial future, At 30 years old, this investor is all about aggressive growth and big gains. Got a high-risk appetite and a super long investment horizon? We're talking over 30 years until retirement. You're all about maximizing that capital appreciation and totally cool with some ups and downs along the way. Sounds like a plan, right? You'll want to aim for about 80 to 90% in equity and keep debt or hybrid stuff around 10 to 20%. Sounds good, right? Here's a fun and simple breakdown of the investment strategy. FlexiCap gets 30%. Mid-cap takes 20%. Small cap gets 10%. Large and mid-cap also 20%. Value fund at 10%. An aggressive hybrid fund rounds it out with 10%. Easy peasy, right? This portfolio is heavily skewed towards equity with significant exposure to mid and small caps. This is appropriate for a 30-year-old who has a long time to recover from market downturns and benefit from long-term compounding. The small allocation to a sectoral fund adds an aggressive thematic bet. Investor age, 50 years old, looking for solid growth and stability in investments. It's looking to keep your money safe while still growing it a bit over time. When it comes to your investment mix, aim for about 50 to 60% in equity and 40 to 50% in debt or hybrid options. Keep it balanced. Right, so here's the scoop on the investment breakdown. FlexiCap gets 30%. Large and mid-cap takes 20%. Aggressive hybrid grabs 20%. Mid-cap scores 10%. Act Value Fund gets 10%. And Corporate Bond Fund wraps it up with another 10%. Simple, right? For a 50-year-old, capital preservation and stability become more critical. The equity exposure is reduced to about 60%, with a substantial allocation to hybrid funds and the introduction of a pure corporate bond fund. This aims for reasonable growth while significantly reducing portfolio volatility as retirement approaches. Small cap exposure is typically eliminated or minimized at this stage unless the investor has very specific, aggressive goals and a high risk tolerance for that portion. Starting a systematic investment plan early is super important. Seriously, don't even think about withdrawing for the next 20 or 30 years. Compounding takes time, and those years of investment really pay off in the long run. Trust me, life advice for everyone, no matter your age. Stay curious, be kind, and enjoy the ride. Before diving into any long-term investments, it's super important to have an emergency fund ready to go. Aim for about 6 to 12 months worth of living expenses. And keep it in something easy to access, like a savings account or liquid funds. Trust me, it's a lifesaver. Setting your financial goals is super important. Think about what you really want, like saving for retirement, your kids' education, or maybe buying a home. These goals will totally help you figure out how long you want to invest and how much risk you're comfy with. Tax efficiency is super important, right? So keep an eye on capital gains tax. For equity funds, if your gains go over 1 lakh in a year, you'll be taxed at 10%. And with debt funds, it all depends on how long you hold them. Got it? Take a moment to review your portfolio at least once a year, or whenever something big happens in your life, like getting married, having a baby, or switching jobs. If one type of investment has really taken off and is way beyond what you planned, it's time to rebalance things a bit. Keep your eyes on the prize. The magic of compounding really shines when you stick around for the long haul. Don't sweat the small stuff. Those market ups and downs are just noise. You can totally create forever wealth. With Indian mutual funds, by thinking about your age, risk level, and what you want to achieve, it's all about making it work for you. What did you think of this story? Keep watching because there's so much more to come. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos. Keep watching.